In this video, we're going to learn what is investing. We're going to learn about the different ways to invest. A lot of people your age don't know too much about investing, think it's a little bit scary, and they think that it goes a little something like this. So I'm just going to stop you right there because everybody has the wrong idea about investing. Everybody thinks you need to be some sort of genius and you have to track all these complicated charts and do all this stuff. But when it really comes down to it, investing is simple. Well, not simple, but it is much easier than people think. When it comes to investing, it uses very basic math. Let me repeat that again. It uses very basic math. Another thing you need to know, investing is not just for rich people. That's another big misnomer. I'm going to repeat that one again. Investing is not just for rich people. Anyone can invest. Really, anyone. Like, you could really start tomorrow if you wanted to. So I think that's enough big letter text for now, and let's move forward. So let's answer this question, what is investing? Like, what is it at its basic core? So investing is the idea that you are going to take some money that you have and you're going to turn it into more money. So the most baseline definition I'm going to give you is that investing is taking money and turning it into more money. That is our goal. So now you must be asking yourself, how? How do you take money and turn it into more money? Well, let's go over it because there's really four main ways. When you really break it down, there's four main ways that you can try to take money and turn it into more money. And let's go over those four main ways right now. So the first way is stocks, and this is the most common investment type. And so at its core, what a stock is it's when you buy shares of a company and you hope to sell them at a higher price in the future. So you buy shares of Nike now or buy shares of Amazon or Apple, and you hope to sell them at a higher price in the future. You can buy stocks on a stock exchange through a broker or through a brokerage app like E-Trade or Robinhood or Acorns. The second way that you can turn money into more money is through government bonds. And so that's when you buy government debt securities. And so without getting into too much details, essentially you're buying U.S. government debt that they pay off year over year. You've heard of the U.S. government is in debt, 30-something trillion. So what that means is they actually owe, a lot of the people that they owe debt to are U.S. citizens through these government bonds and securities. So you can purchase bonds through the U.S. Treasury at treasurydirect.gov. That's the actual link to where you can purchase government bonds. And one thing to note about bonds is that they're the lowest risk, but also the lowest reward investment. They typically pay about 2% return year over year. Third category is real estate. And real estate investing is when you buy housing, apartments, commercial estate, or property. And by doing this, what you end up doing is you generate monthly cash flow by collecting rent, by either renting it out to people or businesses. And you can also sell your property at any time and collect the profits off that. So real estate does two things. It generates cash flow month over month through rent, and if your real estate assets are going up, you can also sell them at a later date, similar to a stock price that's gone up and down. But the benefit of real estate is that you also get that cash flow generating as well. The one thing about real estate, though, that is hard for most people is that you need the most money up front to invest. You can invest in stocks and bonds with, $1 theoretically, but real estate, you actually need quite a bit of money up front because real estate is very expensive. And the final category is currencies and cryptocurrencies. So this is when you buy or trade currencies hoping to sell them at a higher price in the future. And so, again, it's very similar to buying stocks where you purchase a currency and you just hope to sell it at a higher price than what you bought it at. So this can be actually national currencies, like you can trade US dollars based off Japanese yen or euros or vice versa, or it can be cryptocurrencies such as Bitcoin and Ethereum. And there's a lot more cryptocurrencies than Bitcoin and Ethereum. Those typically are the most known and the most popular. So, one thing to note about currency and crypto investing is this is the riskiest type of investment. You really need to know what you're doing and you need to pay close attention because they are very volatile, meaning very large spikes. So, you can make really big gains, but you can also lose on very big drops. It's very very spiky. You can go up a lot in one day or down a lot in one day. So you do have to know what you're doing when you get into that. So now let's look at measuring your investment. And in the world of finance, this is known as ROI. Or if you break it down, that's just an acronym for return on investment. And what that really means when you break it down is just asking the question, how much did you make or lose on your investment? Did you have a good ROI, a good return on investment, or a bad ROI, a bad return on investment? And so calculating this is actually very, very easy. It's just the initial money that you invested measured against the money in your investment account. Again, whatever investment account it is, whether it's a real estate or a stock account or an account where you store government bonds. And so you're just measuring the initial money you invested and then measuring that against the current money in your investment account, however many years or months later. So in this case, if you grew the account, that would be a positive ROI. If the money in your investment account is more than the money that you invested, that's a positive ROI, and that means that your account gained money. You made money off your investment. But that does not always happen. What if you invested your money into an account and then you look at the account years later and there's less in there? So you have less in the account than you initially started. That's a negative ROI, and a negative ROI means your account lost money. And when investing, that's something you really want to avoid. So let's look at some actual examples with actual numbers. So let's say you invested $1,000 into a stock account, and then 5 years go by and you check the account and you have $800. Well, that's going to be a negative ROI, a negative return on investment of $200, and that just means your account lost $200. Let's do one more example, and let's say you invested that $1,000, and then 5 years go by, and now the account is at $1,750. Well, that's just going to be a positive ROI of $750. And that just means your account gained $750. So as you can see, the ROI calculations are very, very simple to make. It's just looking at the initial money you invested and then looking at how much money is in the account now and did it grow or shrink. So a piece of advice for investing. This is, I think, a really good piece of advice from Warren Buffett, who's also known by many as the Oracle of Omaha. Some people say he's the greatest investor of all time. And he took this small company from Omaha, Nebraska in the 60s, and he turned them into a $685 billion company, as you can see right there in yellow. $685 billion. He still runs the company today, and he did it all just by investing into companies throughout the years. So here's a piece of advice for his number one rule of investing. And for new investors, I think it's very smart to take this advice.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule. And that's all the rules there are. I mean, if you buy things for far below what they're worth and you buy a group of them, you basically don't lose money.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort.
So there you have it. You don't need to be a genius. You just have to have decent temperament when doing investing. So let's again remind ourselves of the 4 types. We got stock investing, bond investing, real estate investing, and crypto investing. So we're going to go over each one of these categories in more detail throughout the course. I just kind of gave you a broad overview of each one of those in this video. So going forward, what I want you to take from this video is how you invest is up to you. There's many different strategies and preferences out there, so come up with your own strategies and preferences, do some research, and just know that at the end of the day, it's your decisions that you're making when allocating money to investing. It's always good to do your research and know what you're investing in. Don't just fly blind out there. Know what you're investing in if you are investing. And then finally, know what your ROI is, if you're making money or losing money, and try your best not to lose money over the long term, just like Warren Buffett said. So, hope this video helped your broad understanding of just what investing is and the different ways you can invest. And like I always end each video, have a nice day.